We'll enter our ticker, we'll select our covered call strategy. Let's avoid earnings for this backtest. We'll look at 2 years of history and we'll trade every 30 days, that is monthly options. And here are the results. We can see that doing a covered call on Apple but avoiding earnings returned more than 20% over the last 2 years. That 22% compares to a stock return of just 6.3%. So we're looking at huge outperformance while avoiding risk. We can take a look at those results in the chart below. We'll just zoom in for the last month. We can see the covered call returned 22%, and there's the stock at 6%. But let's go further. Let's see what would happen if we traded covered calls only during earnings. And here we see those results. A covered call during earnings for Apple was a loser every time. Here we can see it in the chart. The covered calls were all losers, while the stock returned 6%. We can dive deep into the details and see the specific results. We're looking at 15% underperformance if we did covered calls during earnings. So in conclusion, we could see that doing covered calls but avoiding earnings returned 22%. Doing covered calls during earnings was a loser, negative 7.8%, while the stock returned 6.3%. Trading with intelligence, the CML Viz option backtester.